We're gonna skip futures, get back to them on maybe on Thursday, but we gotta get options because the exam questions are on options, and options are a lot more fun than futures anyway. So an option, just like the word says, it gives you the right to do something, but you don't have to do it. It all has to do with some future expiration date and some strike price. So it gives you the right to do something within some period of time. The more time you have, the better the option. And then you get some strike price. And does something have value just because you have the option to do something? In finance, we'll say yes, it has a value. We did stock valuation. There is a component of stock valuation, which is optionality value. We're not going to cover that in this class, but the motoring covers it very well in his class. The fact that an oil firm could explore for oil on land it owns, but doesn't have to. They could spend $1 million to find oil that's worth hundreds of millions of dollars. They don't find anything, they shoot it down. That's an optionality. So optionality gives you the right to do something. You might not do it today because it isn't worth it today, but you might do it in the future. Options tend to have huge payoffs a small percentage of the time, but then most of the time you just lose all your money. That's just the nature of options. I've had options that were up 40,000% in a couple of days. In fact, I'll give you one because I was monitoring this one. So you remember GameStop and the whole meme stock. So if you had bought an option on GME, you could have paid 70 cents for an option with a strike of $30. This was several years ago. That 70 cents a few days later was worth $313.50. So you wouldn't go from 70 cents to $313. Do you do that on a stock? You're not going to do that on a stock. It just doesn't happen. So if you invested 10,000 bucks, you would have been worth $4.5 million. Now GameStop's unusual, right? Back then it went from like a $20 stock to a $400 stock. They've split, so they're not that high. Was it worth that much? It wasn't worth 400 bucks. It's not worth 20 bucks today. It's a firm going out of business. But because of this unusual behavior, where people were just artificially shooting up the price, yeah, the option just shot up. So you would have made a lot more money buying the option than you would have buying the stock. The stock, you would have gone up 20-fold. With the option, you go up 500-fold. So, but there's a good chance you would have lost 100%. You're probably not going to lose 100% if you buy the stock. So that's what an option is. An option gives you the right to buy something, that's called a call, or to sell something, that's called a put. So calls are bullish, puts are bearish. So calls, you hope things go up in price. Puts, you hope they go down in price. So option is in or out of the money or at the money. For a call option, if the current price of the stock is greater than what you can buy, that's called in the money. So I would say, hey, I'll give you the right. Well, let's just look at an example. Let's do Estee Lauder because we're just talking about, right? We were talking about buying them 2 weeks ago and their stock's up a bunch. So of course we didn't buy them, but let's go do some options. Here's the options. And let's go out. So time is important. So we'll go out, say, to March. They're currently trading for 77 bucks. So an option to buy their stock at 65 bucks would be in the money. If you have the option, I'm sorry, I said that backwards. So if you have the option to buy the stock at 65 and it's certainly trading for 77, that's in the money. That's something in the money means you would do it, right? If you could buy the stock for 65 and it's currently trading for 75, would you execute? You would, so that's in the money. Out of the money would be the right to buy for 90 bucks when it's currently trading for 77. Would you execute this option? No, you wouldn't do it. But it still costs you money. It's still going to cost you $2.93. Now, why would you pay $2.93 to buy something for 95 bucks that you could buy for 77 bucks today? Well, because what happens if the stock goes to 105? You get to buy for 95, you can sell it for 105. You only pay $2.93, make a big profit off of that. All right. And percentage wise, you'll make more money doing that than buying the stock at 77 and selling it at 105. If you buy the option at 293 and the stock goes to 105, you're going to make $7 gain off of a $3 investment. You're going to make 200% return. So you make a higher percentage return on the option. What do you notice about the option price as the strike price goes higher on the call option? See how it gets smaller and smaller and smaller. Well, until you get this doesn't make any sense. They show the last price. I should look at the bid and ask because that makes more sense. Even this doesn't make any sense. So yeah, it's sometimes what happens with options. I noticed this at USA is they're really, really old numbers because no one's bid, no one's traded on this stock in months, on this option in months. So it's just a really, really old number. I noticed that USA had one mutual fund that used a lot of options. And I called the department and said, there's no way my NAV is correct. And it's because they were using last price. Well, last price could be 3 weeks old. It could be an old number. You can't use that. But even the bid and ask, I mean, these bid and asks don't make any sense either. So they're just old numbers. So you can't really trust them. But when you're near to the actual stock price, you can trust the numbers a lot better, and it does move. When you move into the money, the option gets a lot more expensive. So you say, hey, I want to buy this stock for 65. We're using an option. You got to pay 15 bucks. You could just buy the stock for 77. So, I mean, that's pretty expensive. Not many people buy options in the money. We'll talk about a few strategies that do that, but usually you're out of the money. So why would you buy this for 80 bucks? Because you think it's going to rise. You pay 7 bucks. If it rises from 77 to 85 bucks, then, you make $5 on the option, right? Stock goes to 85, you have the right to buy it for 80. So you can buy for 80, sell it for 85. So you made $5, but how much did you pay for the option? You paid $7. So how did you do? You didn't do very well there. You paid 7 bucks and you made 5. So you lost $2 on the transaction. But that's what a call option looks like. In the money means the strike price is lower than the current price. So you would definitely execute that. You would definitely buy the stock for 50 and then turn right around for 77. Put options, the exact opposite. Put options, you have the right to sell it for 65. That's out of the money. You wouldn't sell this stock for 65 when it's worth 77. Just doesn't make sense. Sorry. Bill Gates thought I wanted to go back. So these are out of the money and these are in the money. You get to sell the option for 85. I mean, sell the stock for 85. It's worth 77. That you would do. So it's in the money. What would at the money mean? Where there is no at the money. Because what's at the money? At the money is $77.32. That option doesn't exist. So there's nothing at the money, but we're kind of around. So between 75 and 80, that's kind of at the money. So if the current price is greater than the strike, that's called in the money for a call. That's out of the money for a put, and then the exact opposite when the strike price is higher. So what influences the option price? And we had one class, we came up with this Texas video. I used to put those on the exam, but it's so easy. I don't anymore. It's like giving points. But we just think Texas video. So we don't have to do it in order, but start with the X. Now it depends if you're a bowler or a baseball player. If you're a baseball player, you might use a K. But if you're a bowler, I use an X. So strike and baseball, it's a K, and bowling, it's an X. But strike is an X. I can't come up, I guess you could say tickets video or something with a K. But the strike price for calls, the higher the strike price, the less valuable the call is. Because that's how much you have to pay for it. So the more you have to pay for it, the less valuable that is. So higher strike means lower call option price. For puts, the exact opposite. Because that's the price you get to sell at. The higher the put price, strike price, the more valuable the put is. All right. For time, that's how long you're going out into the future. Time hits options the same, whether the puts or calls. The more time, the more valuable the option. I can show you that with this example here. With Estee Lauder, at 80 strike, call is 710. If I go out to June or July, 80 call is 970. Goes from 710 to 970. Just having that extra time. Why? Because you're more likely for it to go into the money and be valuable to you. So time increases both puts and calls, both directions. Now, on the exam, you actually have to calculate the time value of the options. Well, I'll show you that math. You might have already done it if you watched the video for Thursday. But time decay, what this means is, okay, so what is time value? You'll see time value, especially on Thursday's team exercise. But this option, let's go back to March, just a little too extreme. So this option costs you, well, let's say $7.30. That's the ask price for this option. So you pay $7.30 to give you the right to buy the stock for 80 bucks. This option is out of the money, right? Because you have to buy the stock for 80 bucks, but it's currently worth 77, so it's out of the money. When an option is out of the money, all of the option premium is time value. There's no intrinsic value. It's all time value. When it's in the money, 70. So how much is this one in the money? You have the right to buy the stock for 70 bucks, but it's currently trading for 77. How much is it in the money? $7. That's called intrinsic value. Time value is the option price minus the intrinsic value. So here, the option costs $12.60. The intrinsic value is 7, so the time value is $5.60. All right, we'll get more practice on that, but that's what time value is. Intrinsic value is the value of the option itself. So you can buy the stock for 70. It's currently trading for 77. So intrinsic value is $7. That's how much that thing would be worth if you're at expiration of the option. It's about to go out, it's about to expire, it'd be worth $7. But you're paying an extra $5.60 for that extra time you have until it expires. So this one, 85 bucks, is out of the money. So that entire 540 is time value. There's no intrinsic value there. Now puts are the exact opposite. For a put, you have the right to sell this stock for 80 bucks, but it's currently worth 77. So there's no intrinsic value. So that means this, wait, I said it backwards. Sorry. So 70, you have the right to sell it for 77 bucks, but it's currently trading for 77. So there's no intrinsic value. You wouldn't do that. So the entire option price is time value. For 80 bucks, you have $3 of intrinsic value, $9 option. So you have $6.20 of time value. All right. So we'll talk about time decay more. What time decay means is as you get closer to expiration, that time value shrinks down to 0. Expiration, it's worth 0. So at expiration, the option's worth that intrinsic value because you don't have any more time left. That's called time decay. Time decay is really, really important. If you're gonna buy and sell options, when you buy options, time value is your enemy. When you sell options, time value is your friend. So at USAA, when we did options, we would buy options 2 months out, sell options 1 month out, so we could retain as much of that time value as possible. Time value is your enemy. When you're buying options, it's your friend when you sell options. But we'll get into that. I'll show you that, especially on callers when we talk about callers. Right. So you've got time, you got strike. The next one is the underlying security price. That's 77 bucks. This goes the exact opposite direction as the strike price. The higher the current price, the more valuable the call option versus the higher the strike price, the less valuable the option. So the more valuable, the higher Estee Lauder goes up, the more valuable the call option is. The exact opposite on puts, the higher the current price of the underlying stock, the less valuable the put option is. So strike goes in the opposite direction for calls and the same direction for puts. The stock price goes in the same direction for calls and the opposite direction for puts. V, anybody know what V stands for?
Volatility.
Volatility, yeah. So volatility is just like time. No, the more volatile the underlying stock is, the more valuable stock and more valuable options are. Doesn't matter if they're call options or put options. The more volatile the stock is, because the more likely you are that it's going to go into the money, you're going to make some money. So volatility, we talked about this earlier when we were talking about convexity. The more volatile interest rates are, the more valuable that right to prepay. And so that harms your mortgage-backed security because you're actually selling that option. The unique thing about volatility, it's the one thing we don't know when we buy the option. We know the time, we know the strike, we know the underlying stock price, we know interest rates, we know probably what their dividends are going to be, but the one thing we don't know is volatility. That's the big unknown when we entered into the transaction. And that can change quite dramatically. But volatility makes both calls and puts be more valuable. And you'll notice how this directly contradicts the capital asset pricing model. With the capital asset pricing model, you use a higher beta, you have a higher discount rate, it makes the stock less valuable. With options, more risk makes them more valuable. So Black and Scholes, who came up with the option pricing model, they started with CAPM back in the 70s. They were trying to come up with a model to price options, and they had to throw CAPM out because it wasn't the right model. So their model, if you look at their model, we'll look at it in a second because it's not that complicated. It looks more complicated than it really is, but it's very, very different. They say volatility is the most important thing. That's what it really defines, because essentially what an option is, it's pricing the probability this stock goes above or below that strike price. And so volatility is the main culprit for that. Time gives you more chance of that happening, more time. Interest rates are fairly immaterial, but they can be getting more material now when interest rates are higher. So essentially, if you think about buying a call option, you pay $7 for the call option instead of spending $77 for the stock, you pick up time value money. Instead of spending $77, you only spend $7. So that's where interest rates increase the value of the option, because you're getting more value of delaying that purchase. But I'm not that picky on knowing that one. It's not that material. Dividends we can kind of ignore, but we usually know dividends. But if it's, remember we said earlier on ex-dividend days, stock fall in price. So when a firm announces a dividend, it goes X, stock price falls. Well, that's going to hurt call options and is help put options. So that has to be priced into the option. But if you look at the formula, and I used to have this formula memorized, but I can't remember it now. It's been too long. I memorized it for the CFA. So you're going to see all the things, and they're asking for money again. They're always asking for money. So here's the formula. So you see that log normal of what is S, remember? It's what? The underlying stock, right? That's at $77. What's K? We call it X. That's the strike. Don't think S is strike. S is the stock price. So essentially what you're saying is what's the probability this is going to reach that? What is R? Anybody know R? What do we usually use R for? Of Texas videos, what is the R? Is it time? Is it strike? Is it stock? Is it volatility? Is it interest rates, or is it dividends?
Interest rate.
Interest rates. What's I won't say the word. What's standard deviation squared? In Texas video, which is that? That's volatility. What's T? Not Texas, but T for time. That one actually fits. It's all in there. I don't make this stuff up. So it's all in there. What are all these D's and all this? That's essentially a normal distribution. You're just looking to see what's the probability this is going to catch up with that based on what interest rates are, what the volatility underlying in is, and how much time I have left. That's all it is. For the interest rates, they use continuous compounding. You probably had that in another class, but not a big deal there. But that's all they're doing. I mean, it seems really complicated, but essentially all they're doing is going through a normal curve and saying, what's the chance this stock price is going to go above the strike or go below, depending if it's a put or a call. So it's not all that complicated a formula. There are other formulas out there. It can get pretty complex. If you take the speculative markets class, Brian Wolf will walk you through all of these. We're going to talk, here's the Greeks. Some of you kind of know Vega starts with a V. So that's Greek related to volatility. Theta starts with a T. That's the Greek related to what? The time. And rho, related to interest rates. So, the Greeks are kind of overlapping. just remember Texas video. It gives you a sense of what are the inputs for an option price. The most important one is volatility. If you go to the Chicago Board of Option Exchanges site, cboe.com, they have all kinds of educational tools. They even have a Black-Scholes pricing model that you can put in your assumptions and come up with an option price if you'd like to. All right, so here's the Greeks. Delta is essentially asking how much will the option price change given the change in underlying security? So if delta is 1, that means, hey, if your stock goes up 10%, the option goes up 10%. That's the delta. Gamma is the change in the delta. Gamma is really important on some strategies. We'll look at collar strategies. We did collar strategies at USAA. Gamma is extremely important. I did a lot of gamma trades when I was at USAA. Because delta looks pretty good. Hey, if the stock's up 10%, my option's up 50%. That sounds pretty good. But if your gamma is negative, that 50% might become 0 at some point. So you got to really watch the gamma. Theta is the percentage change in the option due to the passage of time. How much will the option price fall because you go one more day into the future? That's the theta. Vega is the change in the option price given a change in volatility. And then rho, it starts with an R, so just think interest rates. Rho is the change in the option price given a change in interest rates. It's probably the least important one because most options only go out 2 or 3 months. So it's not that material, especially 3 years ago when interest rates were practically 0. Rho had almost no impact at all. So delta, gamma, theta, vega. The first options I did at USAA, my option trader at Credit Suisse, a guy named Stu, really smart guy. He sent me an Excel spreadsheet with all my Greeks on it. And that's when I saw my gamma. I go, my word, my gamma is terrible. I'm going to get out of this option as fast as I can if I get a chance, because it was just horrible. You know, you have to watch these things. I don't think I spent much time looking at rho, but theta and vega, you look at them, you kind of know what kind of strategy you have. You can't assume it's going to be the same all the time because options can change pretty dramatically depending on your strategy. So those are the Greeks. I don't know how heavily Brian Wolf covers the Greeks in his class. These all have formulas to them that you can calculate. If you go into Bloomberg machine and you type have a function OMON, that's their option model. And I think you can do 20 legs. I mean, it's pretty crazy. You can set up some really, really sophisticated strategies and you can test them, run different scenarios against them. They give you all of the Greeks. You can look at your strategy, you can look at your gamma, you can try different times. You can go long and call option, go short call option, go long 3 put options, short 3 put options. You can do all kind of spreads and everything else. And you can set all that up in Bloomberg and test it and see how you're doing. It's a pretty good model. Gives you a lot of really good information just at your fingertips, so you don't have to do your own building. So they'll give you all the Greeks so you can see what your strategy, what kind of what you're actually betting on. So these formulas, you have to know these 2 formulas. If you know these 2 formulas, the exam's pretty easy, very easy. So again, this is the video I put out on YouTube. That's the most watched video I've ever made. It's 130,000 views. I don't know why. Because all I'm doing is saying you bought an option and you're going to shut it down at expiration, watch your gain or loss. About as simple as you can get. At expiration, and be real clear in your notes, at expiration, remember time value. Time value is a different amount. Time value is going to give you a different, but at expiration, time value is 0. So all we have is the intrinsic value. So this is the formula for the value at the end. And this function here before the minus the option, that is the intrinsic value. Max S minus X and 0 is the intrinsic value for a call. Max X minus S, comma 0 is the intrinsic value for a put. If you know this formula, you know the intrinsic value, you can handle the exam question very, very easily. We'll see that on Thursday, practice a little bit more. So what does that say? Well, why does it say max? Because if your option is out of the money, you'll just let it expire worthless. So the worst you can do is it expires worthless at 0. So if you have the right to buy Estee Lauder for 90 bucks and it's worth 70 bucks, you're not going to execute that option and lose 20 bucks. That'd be stupid. So you just let it expire. What do you lose? You lose whatever you paid for the option. All right. So the worst case scenario is you lose the option premium. But if the stock is 90 bucks and you can buy for 70 bucks, that's now worth 20 bucks. That's greater than zero. So 20 minus your call option, that's your gain at expiration. All right. The intrinsic value is 90 minus 70 or 20 bucks. Your intrinsic value, I would put this in your notes. Your intrinsic value minus what you pay for the option, that is your gain. For a put, you notice that we switched the X's and the S's. For a put, it's the strike price minus the stock price. So we have the right to sell Estee Lauder for 70 bucks and it's currently trading for 90 bucks. We're not going to do that. We're not going to sell it for 70 when it's trading for 90. We'll just let it expire as worthless. Our only loss is what we pay for the put. But if we can sell it for 90 and it's currently trading for 70, 90 minus 70, that's a $20 gain. That gives us a $20 gain minus what we pay for the put. That's our gain. So the intrinsic value is the max X minus S comma 0. The gain on the option is that minus what we paid for the option. And we can do all kinds of cool combinations. We can buy calls, we can buy puts, we can buy calls and puts, we can buy different types of calls, we can buy calls and sell calls, we can buy puts and sell puts, we can go long, we can go short, we can have different strikes, different maturity dates. We can hold the underlying, we cannot hold the underlying. There's so many different choices you have here. I'm trying not to say the word option. And one of my favorite theories in finance, it's not even a theory, it's just a mathematical formula, is the put call parity. Have y'all heard of put call parity? Really, really good. It's a replication strategy. So what replication means in finance, you might even Google this. It's pretty cool part of finance. So replication strategies in finance. And they'll give you all kinds of examples of them. So what replication means is you want to buy A, but you're not allowed to. But if you buy B and C and sell D, you essentially get the same thing as A. So you're going to replicate A by buying B, C, and selling D. Put call parity is a replication strategy. What it says, it's really, really cool. It says a call plus a bond is the exact same thing as a put plus the stock. A call plus a bond. What kind of bond is this? This is a bond that you buy today that matures exactly at the strike price. So if you bought a call option today for $7 and you put $93 into a bond that's going to mature at the strike price, that's the same thing as buying a put today and buying the stock. You'll get the exact same answer. And you can move these around. So that means if you wanted to buy this stock, but you weren't allowed to, what could you do? You could buy the call, have the bond, and you could sell the put, and it'd be the exact same thing as buying that stock. Pretty cool, right? I mean, it's pretty amazing. So if you wanted the stock, you just sell the put, buy the call, buy the bond. That's the exact same thing as buying the stock. If you want to buy the call, but you can't, then you would buy the put, buy the stock, and borrow the money to do it. That's how you, I mean, it's the same thing. Why is this so important? Well, in replication, if this costs $99 and this costs $100, I would sell that and buy that. I would have $1 risk-free. That's called arbitrage. And how much would you do with that? Would you do 10 shares, 20 shares, 50 shares? You can sell this for 100. You can buy this for 99. You know at expiration, they're going to be exactly equal to each other. How much would you sell? How much would you do with that? About 80 trillion shares, right? Why not? There's no risk. I mean, there may be risk on the way if it bounces along, but there's no risk essentially. So that's what replication is. And replication, some replications are perfect. This one's perfect at expiration. It may not be perfect as you go because time value can do some strange things, but it's perfect at replication, at expiration. And so, you know, hedge funds are looking at this all the time. If they can see a mispricing like this, even if it's only pennies, they'll execute so they can pick up that arbitrage profit. I wish I could show you put call parity, but for it to work, I have to be exactly at the money. I have to find an option. I have to find a stock that's trading for exactly like $75.00. That's the only way it works. And then even when I do it, I got the problem with the bid ask is going to be off. So you can't get it. Small investors can't get it exactly right, but hedge funds can make money doing this. They're not going to make a lot. These opportunities aren't like out there like just screaming. I saw one of these in 2008. I was so tempted to just quit my job because there's an opportunity there. It was just crazy. But I don't know if I'd actually try to execute it, if it would have actually been there, but boy, it looked too good to be true. So every once in a while you get a market that just gets disrupted. But hedge funds watch this very closely, so it's going to be in place. Now, if you see a mispricing like this, it's probably what we saw before. We just have old data. The prices are old. They haven't traded in a while. So if you actually put a trade in, you're probably going to be shocked at how bad it comes out. So if you do that, what should you do? You should do a limit order of some kind. To make sure, if you're expecting to be $3, put a limit order at $2.99 or something. So you make sure you're pretty close. Otherwise, you could get crushed on a trade like this. But that's replication. You can Wikipedia this if you want to. Put parity, and they'll show it to you. They'll give you the formula. So here's the formula I just used, and they differ. There's all other kinds of strategies you can do. So it's pretty cool. So one thing you're trying to do is find almost perfect replications that are mispriced. In 2008, what happened was that futures and underlines got mispriced. And so there were some incredible opportunities in 2008. And the reason for it is that derivatives are more liquid than the underlying security. What people were doing is they were panicking in 2008. They need to sell. I know y'all don't remember 2008. You're like in kindergarten or something. But in 2008, people were just panicking and they were selling. And so what we say, there's a saying, in a panic, you sell what you can, not what you should. So they were selling the futures because they were liquid. So the futures got mispriced versus the underlying. That was a case you probably could have taken advantage of that. Now I realize some of y'all know in 2020, oil futures went negative. Say, how's that actually possible? I don't think you could have executed that unless you had a massive warehouse. You could accept millions of barrels of oil. Because why did they go negative? Because there's no place left on the earth to store oil. So the futures went negative because there's no storage. If you had a big oil depot, yeah, you could have made a fortune. You could have bought oil and they would have paid you for buying oil. That's pretty cool, right? Kind of like when USA sold Fiesta Texas. They sold Fiesta Texas and they had to write a check for it. It's not good when you sell something, you have to write the check. Usually when you sell something, you want them writing a check to you. Well, with oil prices in 2020, you could have bought oil and they were going to pay you for buying oil. That doesn't happen very often in finance. Those are those bizarre cases. But you get a disrupted market like 2008, 2020, those opportunities come, you got to ask if you can actually execute on that because you may not be able to. All right, so here's the strategies we're going to have on the exam. And we have calls, puts, protected puts, covered calls, long straddle, and a collar. All right, those are the strategies. We're not going to do spreads. We'll talk about spreads, but let's just go through each one of these and we'll learn them as we go. We'll see how many we can get done today. So let's start with a call option. Let's do Estee Lauder. Why not? So the current price. Markets are closed. So I've got the closing price 77.28. I'm just going to say 77 to make it easy. And we want to do a call option. Maturity, we'll do 3/2024. We'll do a strike and we'll do the option premium. We're going to do the ask because we're buying the call. So what strike do we want? $77. So this is a stock that was trading for 150 bucks earlier in the year. A few weeks ago, it was trading for 100 bucks. It's now bounced off. Yeah, remember, look, we were talking about it right here. So, you know, if we had bought it, it would have kept going down, but we didn't, so it's going up. So, wow, I mean, it looks like 100 has been a kind of a resistance point. So if it hits 100 and breaks out, it's shooting up. So I'm going to pick 90 as my strike, because if hundreds of resistance, if I do the strike at 100 and it never breaks out, I'm never going to make money on the option. So I'll put my strike at 90. Let's get the strike premium. We're going to go out to March. We want a 90 strike. So what are we going to pay? $4 or $3.80? Ask $4. Always the higher. If you're buying, it's the higher number. If you're selling, it's the lower number. That makes it real simple on the exam. All right, so let's go to expiration. Let's say at expiration it's trading for $30. Or maybe it's trading for $30.50. Maybe it's trading for $120. All right. If we had bought the stock, we bought the stock for 70 bucks. It's now trading for 30. We'd have $30 minus 70 bucks, 77 bucks. We would have lost 47 bucks. So the gain or loss on the stock is pretty easy. It's just a diagonal line, up and down. But if we do long the call, gain or loss, remember the gain or loss equals max of the stock minus the strike, comma 0 minus the call premium. All right, you have to know that for the exam and for life. Don't forget it after the exam. You didn't know this real simple formula. So equal max, the strike price is 30. Stock price is 30. The strike price is 90. So what's that going to be worth? You have the right to buy this stock for 90 bucks. It's currently worth 30 bucks. What are you going to do with that option? You're going to execute it? Pay 90 bucks for this stock? No, it's going to be worth 0. So what did it cost you? Cost you the option premium. It's your gain or loss. And that's going to be true until when? If the stock goes for 90 bucks, you take 90 minus 90 minus comma 0. That's 0 minus $4. What happens at 90 bucks? Do you make any money? So when are you going to start making money? What about at 92.50? What happens? You can buy it for 90, sell it for 92.50. What's going to be your gain? Anybody can guess the gain or loss? Well, 250 is your gain, but you paid $4 to get it. So what's your gain on the option? Is it a gain or loss? Loss. You lost $1.50. What happens if it goes to $4.95? How much will you make or lose? $1. And then from there, it's just going to go up $2.50. All right. So the stock looks like a diagonal. What apparatus in sports does the call option look like? A sport we don't play in Texas. They play it in Canada, but they don't play it in Texas. Yeah, it looks like a hockey stick. That's what I mean, it's a really long hockey stick, but that's what the call option looks like. If the stock price doesn't go up, you just lose your option premium. At some point at 94 bucks, right? And 94 bucks, you break even, right? This is at 94 bucks. At 94 bucks, you make $4 on the option, but it costs you $4. So you're exactly at 0. And then you just start making money all the way up. Now remember put call parity, because we're going to see this picture again. right? We're going to see a replication of this picture when we get the puts, right? So we graph the two of them together. Here's the stock price. Here's the call option. Here's the actual stock price itself. I may not format all of the graphs because it takes too long. Yeah, Bill Gates does not do a good job guessing what I want. So the option looks like a hockey stick, but the stock itself goes like that. And you might say, well, the stock does a lot better. It does a lot better as far as your dollar gain, but your percentage gain is going to be much, much higher in the call option because the stock, remember, is cost 77 bucks. So you make 50 bucks when you paid 77 bucks. That's not as good as making 30 bucks when you paid $4 for the option. All right. Now, some of you are thinking, don't you have to do 100 options in a contract? We're ignoring that for this class. All right. But it is true. Each contract option, not each option, but each option contract has 100 options in it. So we'd have to do 100 of these. So we'd have to spend 400 bucks. We're only going to do one option just to keep it simple. Right. So just forget the 100 times 100. Everything we're doing here, it's so simple. You just multiply by 100 and that's what the contract would have done. There's nothing special about it. I don't want to multiply by 100 every time. All right, but remember this, when you do put call parity, you're going to see this line again. So that's what a call option looks like. You're limited on the downside, but then you have huge percentage gains on the upside. Just like with GameStop, you bought the call option there, you've been up from 70 cents to 314 bucks in just a matter of a few weeks. I mean, it's just insane what an option can do. If you're really sure something's going up in price, yeah, do the option. That's going to give you a much bigger bang. I don't know who won the market watch competition, but if I were in that competition, I'd just be loading up on I'd be selling options and buying options to get, max, because you're either going to be in first place or last place. And that's the way you do it with a game like that, where it has nothing to do with skills. It's all about volatility, right? So that game is all about volatility. You want to have the most volatile possible strategy you can imagine. So, and then you and your friend do it. And you put in fake names. One goes long on the strategy, one goes short on the strategy, and you're assured one of you is going to come in first place and one of you is going to come in last place, and you can split what, 200 bucks. Right? Don't tell the investment society I said that, but it's a good way to cheat the system, right? Because it's so easy. So anytime you see those type of games where, hey, after 3 months, whoever's in first place wins 100 bucks, just partner with someone and find the craziest possible strategy you can possibly find. So it's either going to make you a fortune or lose you a fortune. All right. What about a put option? All right. So currently trading for 77 bucks. Don't need to change that. We'll do a put option. Maturity again, we'll do 325. Did I put 24 before? Or did I type? Sorry. Can't do that option. That wouldn't exist. The strike and the premium. Here again, we're going to do the ask because we're buying. Right. So here they got down to like 40, 50 bucks. So essentially here, what you're thinking is, well, we're only doing the put. We don't own the stocks. So you're thinking, man, this company's in a lot of trouble. They're not doing well at all. This last rise they've had of 20 bucks or whatever, that's totally fictitious. That's just, they're not gonna be able to sustain that. So they got down to low 60s. If you look at it, it's kind of been bouncing around there. So you think, you know what? If it hits 60 again and breaks through 60, this stock's going down to 40, down to 30. So I'm going to put my strike in at 60 here. Thinking this is a stock we're talking investment society, meaning that we call it in finance, it's called a dead cat bounce. I don't know why. But a day count, this is just a stock that's fallen a bunch and it just comes up because it has to come up and then it's going to continue going down and it's going to just crash. So what's the premium here? So we're looking for a put option with a strike of 60. Change the date on me. What do we pay? 160 or 170? 170. Now we have to look and see, are they going to pay a dividend between now and then? Because remember, that helps you as a put. That may make your put option a little more expensive. All right, so here we look at expiration. I'll use the same thing I did before. You can't do all of this, but I'm going to do the same thing I did before. Just bring that over. And so long stock, gain or loss. So again, it's worth 30. We bought it for 77. We lose 47 bucks. Just a diagonal line all the way up. We go long the put. Now with the put, remember the call strategy was bullish. Call strategy, we made money when the stock goes up. The put strategy is bearish. So we're going to make money when the stock falls. So remember the formula here, it's max X minus S, comma 0, minus the put premium. So here, equal max, the strike price is 60 minus 30. What's that going to come out at? That's the intrinsic value. What's the intrinsic value here? 30 bucks. How much do we have to pay to get that 30 bucks? $1.70. We're going to make money until when? What stock price? What does it have to fall to before us to start making money? If it falls to 60 bucks, what happens? We lose $1.70. If it falls to 59 bucks, what happens? We lose 70 cents. If it falls to 58 bucks, what happens? You may do the math in your head. If it falls to 58, what do we do? Make 30 cents, right? What happens if it falls? Someone do this in your head. If it falls to 55 bucks, what do we do? The intrinsic value is what? If it falls to 55 bucks, the intrinsic value is $5 and you paid $1.70. So what's your gain? 330. So see if 55 bucks is 330. Sorry. So you make 330. At 60 bucks, you lose your premium. At 55 bucks, you make $3.30. This also looks like a hockey stick, but upside down hockey stick. So here, that maybe looks more like a hockey stick than the call one did because it's not such a long hand. If it's laying down. So here you have a gain when the stock is down. So this is the long put. I'm not going to fix all the charts because it just gets to be too much. But the stock is just a diagonal. Here, if the stock price goes up, you were really, really wrong. But at least all you lost was $1.70. So it wasn't like you were betting on it that it's going down. You thought it's more likely to go down and go up. If it goes up, though, you haven't lost that much. Questions up to there? You see how important those max formulas are. So y'all tell me, intrinsic value call equals what? So I'm gonna give you the formula. First word is what? Got max. This is a call option. S, the stock price, minus X, comma 0. That's the intrinsic value. What's the value of the call? Your gain or loss? It's that minus what you paid for the option, all right? Remember, that's the intrinsic value formulas. When you're doing time value, remember time value is just the value of the option minus the intrinsic value. That's time value. So at expiration, the options equals its intrinsic value, so there is no time value. The time value goes to 0, all right? What's the intrinsic value? Oh, my word. About the put. Yell it out. Y'all got it? Perfect. Yeah. So you'll use that formula over and over. You probably in almost all of the questions on the option question, you'll have that formula in there somewhere. To me, it's a really simple formula. And for some reason, that video and the comments are like, you saved my life. This is the most beautiful video I've ever seen in my life. And like, these people need a life, because it's not all that great a video. It's a video I made just for our exam. And it's like incredibly simple, but it is really, really simple. That's the intrinsic value. I have people commenting on that video. Well, what about the time value? What about the option pricing model? We're not doing any of that. We're talking at expiration. All right. This is intrinsic value all the time, but at expiration, intrinsic value equals the option value because there's no more time value. So they're the same at expiration. So that's why I'm simplifying it. Before expiration, that's when time value comes in. That's when Black-Scholes formula comes in. That's where we have interest rates and volatility and all this stuff. But in expiration, that is the value of the option. Questions up to there? All right, so those are two strategies, a long call. Now, if we did a short call, it would look exactly like this, but upside down. And we use the bid price instead of the ask price. At a short call, I won't ask you for a short call on the exam, but a short call, everything looks the same. So if you do a short call, all you got to do is change the sign, all this. So a short call would just be minus that. So a short call doesn't look too exciting. A short call, you get the premium if the stock price falls, but then you have unlimited loss if the stock price goes up. So, but the only difference is I use the ask price. When you sell it, you use the bid price. That's the only difference. Same thing with the put. If you go short the put, it's just minus that. And here you lose money if the stock price falls. This is what people were doing in 1987. When the stock market fell 23% in one day, there was a bunch of elderly people that were selling put options, thinking we're clipping coupons. This is like easy. And then the stock market fell 20%. And they were all wiped out. A bunch of 70-year-old people saw their entire. Why? Because how much can you lose? I mean, until the stock goes to zero, I mean, you can lose an enormous amount of money. It's a very, very dangerous strategy. Anytime you short something, just realize it's dangerous. You better know what you're doing. I would never short something to give me an unlimited loss. I would always somehow cap it out on the other side. So going long, the only difference between saying going long or going short, you just do minus whatever you got going long, and then you make sure you switch between the bid and ask price. Other than that, they're exactly the same. All right, the next one's a protected put. Anybody know what a protected put is? Y'all heard of that before? So you can go long on the stock, the underlying, and long on a put. And we've already done this one. I'm lazy, so I'm going to copy this over. Oops, Bill Gates won't let me copy it over. I'm going to copy this over somehow. So we have SA lot at $77. We're going to do a March put option, strike of 60, premiums $1.70. The gain on the stock, we've already done that. I don't know what happened here. Oh, sorry, got to fix one formula. So gain on the stock is 30 minus the stock price, 77. And then for the put, just to do it again, equal max, the strike minus the stock price, comma 0 minus our original. So that's exactly the same as I did here. Nothing's changed there. So what is a protected put? You just add those two together. And you'll notice this 1870 gets repeated a bunch. That's your max loss. The most you can lose is 1870. How in the world do we get that? Because what happens when the stock hits 60 bucks? You stop losing money, right? So what's the difference between 77 bucks and 60 bucks? $17. How much did you pay for the option? $1.70. What's $17 plus $1.70? $18.70. The most you can lose, you're pretty unprotected from here to here. You agree? From 70 bucks down to 60 bucks, you have no protection. So you'll lose that 17 bucks. And then you start gaining money, but you paid $1.70 for it. So the most you can lose is $18.70. But then you have the upside. So here's the protected put. You have the downside and you have the upside. You get a lot of the upside. Up here, you're going to get the stock valuation minus $1.70. So as the stock goes up, you lose $1.70, but you get all that upside. But you cut off this downside. Anybody remember another line that looked like this? Does that look familiar? That look a lot like that. Go back and look at put call parity. What does a call look like? A call is the put plus the stock minus the debt. You can somewhat ignore the debt, but a call is essentially the put plus the stock. Isn't that what we just did? They both have that same shape. So yeah, buying a call looks a lot like buying the stock and buying the put. They're very, very similar strategies. So that's the protected put. So protected put, you have to do the stock gain. The stock gain is just what was the stock price at the end of the term versus what did you pay for at the beginning. And then the put gain is that max X minus S comma 0 minus the original price. You just do those calculations. I'm going to take just so you can see it. That's the long protected put. It's a good strategy. I like it. I'm going to show you USAA. We use something similar. We did a collar, but something similar to this, a long protected put. It is expensive, so don't think about that. Oh, it's only $1.70. You'll notice that's really going to impact your returns. If you do that every single quarter, this is only for one quarter. You do that every quarter. So you take $1.70 times 4, that's going to start adding up to pretty expensive to your overall return. But if you're really worried about the downside, yeah, it's not a bad strategy, especially for senior citizens. Back in 2020, my recommendation was senior citizens, don't put 40% of your money in the stock market and 60% in bonds. I thought it was a stupid strategy because bonds were paying you nothing. My recommendation is put all your money in the stock market and hedge it. I thought you'd come up with a higher return and less downside risk because I thought bonds were going to sell off, and they have sold off quite a bit. Remember, interest rates were practically 0. Why would you put 60% of your money into the bonds when you're making 0? So put 100% of your money in the stocks, hedge it. And yeah, instead of making 10%, you may only make 7% on stocks because you're going to have to pay for those options, but you would have only made 0% on bonds anyway. So you might as well make something on your money. So I like the strategies. I have a blog I write for older investors, how you can take advantage of this. It works quite effectively. The thing I like most about it that you can't say for normal investing is that you know exactly what your max loss is. You can't lose more than that. And for a senior citizen to tell them the most you can lose is 10%, that's a pretty powerful thing to be able to tell them. All right, any questions on the protected put? You're long the stock, you're long the put. All right, let's do the strange one. Let's do a covered call. Anybody know a covered call? You got it, Tristan, anybody remember? You're long what? Long the underlying, the stock, and then what? The short what? Out of the money. You notice all of these have been out of the money. You're gonna buy the stock and you're gonna sell the call. All right, covered call. So I'm gonna bring the call option over. We will have to make one change here, and y'all see it when we do it. Right, so what change, you may know what change we have to make on the call. Everything's set up correctly, except for one thing. What do we have to change? We're not long the call anymore. Now we're short the call. We have to change the game. We're going to do the game over here, but it's here, right here. Right? You're not going to use the ask, are we? You use the bid that we're selling. So let's go get that. So $90. That's $3.80. So if we're short the call, it's real simple. It's the exact same formula, but just be real careful on this. You put a minus sign in front of everything. And everything, not just an intrinsic value, in front of everything, because you're receiving the call. So whatever you did for the long call, that number, you just change the sign to the opposite sign. All right, so it's minus everything. All right, so the gain on the stock is $30 minus 77. And here we got, I'm going to set it up incorrectly first time. So max the stock price minus the strike, comma 0 minus 380. That would be the value if we were long the call. But we're short the call, so we put a minus sign in front of that entire thing. And that gives us short the call. And so the covered call, you just add those two together. I'm going to take out call option. There's the covered call. Now it looks really pathetic though, doesn't it? On the way down, you lose money, but not as much as you would have. Why? Because you're getting that $3.80. But once you hit $90, what starts happening? You're short the call. So you start losing money once you hit $90. You remember earlier I mentioned gamma? So down here, your delta might be 1 for 1 or something. It depends. Yeah, maybe real consistent. But as you start going up, your gamma is going to start getting really, really bad, and you're going to stop gaining. You like having gamma when the stock's going up. You don't want, you like it on the gain. Here, your gamma starts going to 0, and actually, yeah, the 0 once you hit the strike price. Why would you ever do this strategy? So let me give you when I would do this strategy. Let's say you valued Estee Lauder and your target price is $90. So you say, hey, if Estee Lauder hits $90, we're going to sell. Well, why wait for it to hit $90? Sell it now. How could you do that? By selling the call option with a strike of 90. Do that now. What if it never hits $90? What do you get? You get you get $3.80, right? You get $3.80. So go ahead and, if you think it's 90 is where you're going to sell, go ahead and sell it now by doing a call option at 90, strike at 90. You get $3.80. If it only gets to $88, then you got the $88, but you got $3.80. So that's going to add to your return. So if you're sure you're going to sell the stock at 90, then yeah, go ahead and do it now and pick up the time value. Pick up that $3.80. Same thing with put options. Let's say, like I love Costco, but its stock's terribly overpriced. Now let's say I love Estee Lauder, but I think it's overpriced. I think it's a great company. I say, hey, if Estee Lauder hits 60 bucks, I'm buying it. I could wait for it to hit the 60 bucks, but what else could I do? I could just sell a put option with a strike of 60 bucks. What happens when it hits 60 bucks? I've got the stock, but what else do I have? I got the put premium. I got $1.70. What if it never hits 60 bucks? I got $1.70. So I'm happy. So those are some really good strategies. Covered call, when you know you're going to sell the stock at some price, go ahead and do it now, collect the premium. Put option, you don't own the stock, but you want to buy it at some price, sell the put option at that price. If it never hits the price, you get the premium. If it hits the price, you're going to buy it at that price anyway. Wonderful strategy. If your broker will let you do it, you got to set it up with your broker. My broker wouldn't let me do my mom's portfolio like that because they kept asking her knowledge of investing and she didn't have a background. So I couldn't get it set up for hers, but these are great strategies. If you're going to buy a stock, man, just go ahead and buy it now. You might be sad if they fall to 50 bucks or 40 bucks, but you're going to buy it at 60 anyway. So, you know, you're going to lose money if you bought it at 60 and falls to 50 and 40. All right. Any questions on covered calls? We'll definitely practice this more on Thursday. I just want to get through them all. So what is a collar? So we did a bunch of collars at USAA. A collar is essentially a protected put and a collar, and a covered call combined. So you're long the stock, long the put, and short the call. You just got, it's everything. Everything's all in there. I'm going to bring the protected put over. And then I got to add some space for the call. You can use what we did here. I know it's faster for me in Excel than it is for you. So there's my option, put option at 60 bucks strike. Here's my short call option, 380. So there's the gain on the stock. There's the gain on the put. So all I got to do is do the call. So again, you can do max, the stock price minus the strike, comma 0, minus the premium. Put that in there, and you know we're short, so you just put a minus sign in front of all of that. That gives you the gain. And so the collar, gain or loss, is you just add those three things together. Now, I don't know what this looks like. No, there's nothing in sports that look like this, but I don't know what that is. Probably some evil symbol of some kind. But anyway, that's what it looks like. That's the collar. But it looks a lot like the put plus the covered call, doesn't it? You're protected on the downside. You're capped on the upside. Now, why would you do this? We did this at USA. Why would you do this? Well, the main reason is that protected put gets really, really expensive. Buying that downside protection gets really expensive. And if you do it every single quarter, you're going to end up with a really pretty pathetic return. Instead of making 9, 10, 11%, you're going to make 4 or 5%. So what the collar does is it helps pay for some of that protection. So you get $1.70, you have to pay $1.70 for the put, but you get $3.80 for the call. So it helps reduce the price. There's something called a zero collar, where you try to get it such that the two premiums are exactly the same. And that way, zero cost. So you essentially your ask price on the put equals the bid price on the call, and this is a zero cost call. So yeah, we did these at USA. Pretty powerful, worked pretty well. There is a mutual fund that does these, and it's had pathetic performance because the stock market has just roared so much. But it's a pretty strong strategy. That's a collar. And then the straddle, I'm gonna call it a strangle because it's really a strangle. That's when you're long, you put, and short and long, I'm sorry, and long call. Right? You already know how to do that because it's just the first two ones that we did. You buy the put, you buy the call, and you just add them together. You're long on both, so it's max X minus S for the put. It's max S minus X for the call. You just add them together, subtract the original. What letter? Well, if it's a strangle is you do it out of the money. A straddle, you do it right at the money. It's really tough to do it right at the money sometimes. But a strangle, you're slightly out of the money. So we'll have to change. We'll have to do this on Thursday. We have to change the numbers because we're not going to use 60 and 90 as our strikes. That's too far away. But the closer you get to at the money, it starts looking like a V. So you lose money. The stock doesn't move much, but if it moves a bunch, makes a fortune. There's a really good book, Trading Corporate Earnings News book. I don't know if I can find the book. Here it is. This entire book is on straddles. So what they're saying is, can you trade a straddle? So you don't know, the firm's about to report earnings, and you think their stock price is going to move a bunch. You just don't know which direction. So you want a straddle. So if it doesn't move much, you lose a lot of money. But if it moves a bunch, you make a lot of money. So you want that V. So you have a negative and then suddenly positive. They show you how to do this. You have to be real careful because straddles can be real expensive around earnings release dates. So I had a friend of mine, he built an entire hedge fund strategy based on this. It was a volatility trade. Essentially what it is a volatility trade. He was making 8 to 10 basis points a day. That might not sound like much, but you multiply that by 250 days, and his worst case scenario is really, really low. So he had a really, really well controlled. But what he did is he looked at the actual volatility of the stock versus its historical earnings releases to try to find some straddles that were mispriced so that he can make a lot of money. He was doing extremely well. It's pretty tedious because you got to look at every firm's earnings. But this book shows you how to do that. And it's a really simple book to read through. It's a pretty good strategy. So we'll do this one on Thursday, but then on Thursday, you also have the team competition. So any of y'all watch the video yet for the options? So you got to do that between now and Thursday to get ready. I'll try to make sure I'll have to look and see. I'll try not to have a strangle or a straddle for Thursdays if you want any of these others. But we'll practice and you can practice some more. All right, I'll stop it there. I will put this file out there. My video, I do it by hand writing, which is what you got to do in an exam. So the video is probably a little more accurate to what you're going to be doing in real life. All right, let's start last class. So we have 2 questions today, so I'll have a little bit more time. It is close enough that another team could get in there. The difference between first place and second place is a point. So if team 2 really messes up today and team 5 really aces it today, it's possible they could catch up. So we'll see. No stress or anything, but so it's 2 points today, right? Because there's 2 questions. So we didn't do straddles and strangles last class, and guess what? The question I got was a strangle. So I'm going to redo question C. We'll work both of them, but question C, I changed it to a protected put. So you have to look up on the board to do the protected put. But I've got the questions here. You have 2 questions. Don't waste time. Move because we can't spend a whole lot of time on it. All right, let's walk through these. Remember on this first question, this one people miss more than any other question. You have to give your rationale. It's not a multiple choice, even if you pick the right one. So I should probably write it like this so you can write right next to them. But so price earnings is fine for all stocks, though best for high growth like tech. But any industry can use PE the ratio. That's fine. Price to EBITDA, what do you say about that one? throw out the ratio because price is only stockholders and EBITDA is stockholders and bondholders. So that whole ratio just gets thrown out. You would never use price to EBITDA. It's a bad ratio. Price to book value ratio is fine, but best, and this one's a little involved for commodity driven firms like energy, high capital requirement firms like industrials, or ROIC focused firms like financials. So there's price to book, that's the one, you know, if it's at Exxon, a steel company, where commodity prices drive it, price to book's common. Firms have a lot of property, plant, and equipment, like industrials, a lot of manufacturing and big buildings. And then banks and insurance companies use price to book. So the one we have left says this is the best ratio for a firm like Rost focused. You might say like Rost in consumer staples focused on margins. So that's a complete answer there. So you have to say, is the ratio fine or not? I'll, you know, here PE ratio is fine for all stocks. I should have said that for all stocks, but we tend to focus on EV to EBITDA and price to earnings for tech. EV to sales, any retail stock, you can use EV to sales. And EV to sales has actually become pretty popular for a lot of firms, even including tech here recently. Throw out that ratio, it doesn't make sense. You'll have at least one ratio that just doesn't make any sense. In price to book, ratio is fine, but this, I don't know if I ever see anyone using price to book for consumer staples. That would be really bizarre. All right, any questions on that one? We'll see if this class does better. We'll see if it's still your worst question. But you could pick the right one and circle it and get 0 points. So I'm not looking for the right answer. I'm looking for the right rationale for all 4 of them. So, all right. So here on this, you need the max S minus X comma 0 or the max X minus S comma 0. Those are the intrinsic values. For the gains, you also subtract the option premium. So on this first one, we're looking at a call option. So that's going to be max S minus X comma 0 minus the call premium. So that's going to equal max. So here the stock is trading for 150. 150 minus the strike of 130 comma 0. So that's $20 minus how much we pay for this option? $720, right? If you're buying, you use a higher number to ask. So that equals what? 1280. That sound right? All right. Team 2 got that right. So team 5, you didn't catch up on them on that one. We'll see if we can catch one on the next one. I don't know what they said on the first question though. Most students get that one right. So this one for a put, it's the max of the X minus S comma 0 minus the put premium. So here is the max of the strike price is 125 minus 90. So that's $35 minus $3.50. What is that? 31.50. Huh? Yeah. Yeah, y'all got that one. All right, this one I'm going to do both of them, but we'll focus on the second one. So here, a strangle is you just buy the put, you buy the call. So it's essentially A and B combined. You just do both of them. you're buying them, so it's gonna be max S minus X comma 0 minus the call premium plus max X minus S comma 0 minus the put. So here you got max. The stock price is 180 minus the strike of 130 comma 0 minus, and we're buying again, minus 720 plus max. The strike here is 125 minus 180 comma 0. That's going to be 0 minus 350. I don't know what all that is. So 50 minus what, 1070, so 3930 or something. Look at Kristen, he answered that one. He got 3990. I'm not sure how you got 3990, but he's real close. I get 3910. Am I doing it wrong? 50 minus 1070, right? 50 minus, yeah, 50 minus 1070. 3930. You're real close. If I did that right, 3970. Hopefully that's correct. You might see an error there. I don't know if anyone answered that one other than Kristen. So that one's, stratos are pretty easy because you just did it already. You did A, you did B, so you just have to do A and B again together. So you have 180 minus 130. So you got 50 bucks on the call, but you paid 720 for it. So it's going to give you 42.80. And then you're going to lose $3. That gives you 39.80. And 60. I mean, I can't do the math for some reason. That's 70, so it's be 30. So that should be 42.80 minus 350. 30. Is that 30 or 70? Well, that's probably 30, right? Am I doing it backwards? 50 minus 120 minus, let me just do it. I'm sorry, I can't do math when people are looking at me. 3930, there you go. All right, sorry. 3930. Kristen, you got 3910, so you probably did, or 3990. You probably did the same thing I did, try to do it in your head. So, all right. What about the put? So on the put, you got the stock gain plus max X minus S comma 0 minus 350. So that's going to equal the stock gain. The stock started off at 131. So the stock is going to make 110 minus 131. So you lose $21 on that, plus the max of 125 minus 110. So you make 15 bucks there. So you're down $6. Is that right? Minus the $3.50. So is that minus 950? Does that sound right? Some of y'all got minus 950.
Sure does.
So that looks correct. See, I keep using this intrinsic value formula over and over again. That's why I think a lot of students are starting to get this one pretty right constantly. And then time value is really, really simple. Time value is just option price minus intrinsic value, which we've done now many times. So it's getting kind of repetitive. So we're doing the call option. The call option premium was 720. So we got 720 minus, well, max of S minus X comma 0. So that's going to be 720 minus max. So the stock price is 131. The strike was 130. Comma 0. So it should be 620, right?
Yeah.
That sound right? Yeah, it's team five, sorry, I think they aced that question. We'll see. Maybe they messed up on the first question. Y'all aced the first question. Let's see. All right. If you got the intrinsic down, it's just a matter of knowing what strategy you were doing. So it's not too difficult. I'll put this out there on Canvas. Any questions on those?
Explain how you get 39. 39, 30, you see? How come I'm getting 15? Sorry.
Well, you make $50 on the call option, right? And the put option's worth 0. And you got to subtract $10.70. Is 50 minus 10.7, 39.30. What are y'all getting?
Oh, you're not doing the 125 minus the 180? No.
Yeah, but that's 0. Yeah, 125 minus 80 is negative, so the max is 0.
Oh, okay.
Yeah. You can never have a negative number on the option.
Yeah.
All right, let's do a straddle since we haven't really done one officially. So I'll bring in my call and my put EL. Here's my call. And then I'll do the put. So their stock is trading at 77. We're going to do this call option has a strike of 90. That's pretty far out of the money, so that doesn't make a good one. So we're going to go back and actually get current numbers here. So we can have something that looks a little bit more like a straddle or a strangle. So they're up to $78. So they made another buck since we last saw them. We'll go out to March again. So we'll try to find something close. Well, let's do $80 at $80. The option is 760. And then we'll do the same thing with the put. So 760, and for the put, we'll do 75, and there it's 620. And so at expiration, stock gain or loss, we have the ending value minus the starting value. We got the call gain or loss, and this formula again, you'll be so used to it. Max of the stock price minus the strike price, and 0 minus premium. So it should be minus 760 until we get up above. Once we hit $80, we start eating that 76. So where will we break even? Any guesses on that? On the call option, what does the stock price has to get to? At 81, we'll lose $6.60. At $80, we lose 760. 81, we lose 660. So where do we break even? 87.60. So 87.60, we should see a break even. Pretty close, right? There's a penny. And then the put, gain or loss, it's going to be, again, it's going to be equal the max of the strike minus the stock option, stock price, comma 0, minus the premium. Where do we break even on that one? It hits 75 bucks, we lose $6.20. At 74 bucks, we lose $5.20. Where do you break even on that one? 68.80. So there's our break even. And so when we graph it, we won't quite get a V, but we'll get something kind of close to a V. Oh, no, we won't, because we have to add them together, right? So the strangle is the two of them added together. So not quite a V, but in the ballpark. This is a long strangle. If we do it right at the money, which means the strike would have to be 78 bucks for both the put and the call, we get exactly a V. But if there's any difference between the strike price, that's why to me a straddle just almost doesn't exist. Straddles don't really make sense because it's rare you're going to find a stock that has a put has a strike price right exactly where the stock is trading. All right, so I'll put this file out there. It's got everything we've done on bonds and stocks all together in one. So for the exam, you need protected put, covered call, long straddle, and a collar. So write down real quick. I'll give you one. You write down what are you long on, what are you short on. All right, I'll start with a protected put. Long what, short what. Write down real quickly. Right. Number two, a collar. What are you doing on a collar? You're long what, short what. Okay, covered call. What are you there? Long what and short what, and then strangle. What are you doing on the strangle? Long what, long what. All right, protect the put. Anybody got it? You're long on
Stock.
long on a stock and on a put, out of the money put. Okay, collar. Do you own the stock on the collar? You do, yeah. On the stock, you own the collar. If you remember, a collar is like a protected put and a covered call put together. So you're long on the stock. What else do you have? A short call, a long put. All right. So collar is like the protected put, and you sell a call option. All right. So you're long the stock, long the put, short the call. All right. What about a covered call then?
Long stock, short call.
Yeah, long the stock, short the call. All right. And then a strangle, kind of the easiest one. You just did it, or we just did it.
Long
Long to
call.
put, long to call, long to put. All right. So those are the ones you have on exam. The one we haven't covered of the basic ones is a spread. We did a lot of spreads at USAA. A spread is when you're long a put and then you're short a put further out of the money. So you might say, okay, I'm going to buy a put at 125, but the cover for some of my costs going to sell another put at 110. So if it falls at 125, I'm covered, but if it falls below 110, I start losing money again, but it helps cut the cost. All right, that's the spread. Same thing on a call. So for me with a call, if I ever sell a call, that's unlimited loss. I mean, you could lose a massive amount. If I sell a call at say 110, I say, I don't think this stock's ever going to go to 110. If it goes to 200, I mean, think about GameStop, right? It went from 20 bucks to 400 bucks. And let's say you sell the call at 30, you're in a lot of trouble. If I ever sell a call, it's called writing a call or going naked on a call. If I write a call I'm going to buy another call out of the money. So if I sold a call on GameStop at 30, I might buy one at 40. Just make sure the worst I can do is if it hits 40. So the most I can lose is that $10 in between. All right. So I'll tell you about my most stressful day, probably my entire life, but in finance. We had a put spread during the 2008 crisis, which is pretty dangerous because we had markets moving a bunch. So the guy I worked with, he was away from the office. So I'm there looking at the markets, and the markets, I'm thinking, man, we were covered by the put, but we had a put spread. So if the market dropped, we start losing money. So we're covered. And I start seeing the market fall apart. So I call my broker and I say, you know what? Buy the put back. I want to exit the spread. I want to be long a put, but I don't want to be short that. But while I'm talking to him, the markets settle down. So I said, forget it, I'm fine. Then it happened again. So I call him again. So I want to buy that put back. While I'm talking to him, the market settled down. So I said, forget it, I'm fine. Third time I call him, this poor guy, he had just started. The other guy we had quit, and this guy was a little shakier than the first guy. I mean it this time, do it. And so he has to send me an email. I have to confirm the email. He does that, I confirm it. And in my memory, it was like 0.3 seconds later, the stock market crashed. And I'm thinking, I'm dead. That was like 200, 300 million bucks right there. I'm thinking, all right, this is horrible. So he calls me. And I'm going, there's no way he either didn't get the trade done, or he did it at a horrible price. So I'm thinking we're going to buy this thing back for 5 million bucks. It's now going to cost me like 150, 200 million. I can't remember how much. It's a massive amount. So did I lose 5 million or I lose 150 million bucks? That's what I don't know on the phone call. And his voice doesn't sound good because Ron, we put that trade in, but man, we got it just in time because right after we traded, and I just almost passed out. So we got it at 5 million. And at the point he called me, it was down 30 times that amount. I literally got up, lay down on the floor until my heart rate got down below 270. Whatever the max is for a 45-year-old before a heart attack, I was one beat below that. I was absolutely stressed. So, I mean, these things are, they're stressful on those days because those were the days where we were seeing, especially at close, we're seeing these massive 10% drops because all these investment bankers are covering their positions, and they cover positions at the end of the day. That normally isn't a big deal, but when they're trading in these illiquid markets, it causes these extremes. So it was a pretty wild day. I wish I had traded on the first time I called him. It would have been a lot less stressful. It's funny, the guy that I work with, he comes back. So I'm the portfolio manager. He's the assistant manager. He's like, man, we just lost a fortune, didn't we? And I get to tell him, no, we bought that put back. We're fine. So it gets stressful. Options are very, very stressful at certain times. You have to make a decision what you're going to do. And so in there, I was trying to make a decision. All right. So here's what you need. A long call, a long put, protected put, covered call, caller, and straddles, strangles. That's the whole thing. I don't know if you can get a picture of that, maybe too small, but that's what you need. But you just keep using these formulas over and over again. Have y'all gotten the sense of that? You just keep using that formula over and over again. So how did my USA work out with me hedging stocks? I thought we did pretty well, and then I got our annual report. And here was the annual report from our CEO. He just passed away this year, a really great guy, wonderful, wonderful guy. That's my portfolio. He put my portfolio in his letter to the board, to the members. My portfolio made 1% and the market was down 37%. If I hadn't gotten that one day, we would have been down maybe, I don't know, 10 or 15%, who knows what. So I'm really glad I got that one day. But he put it in there. I forget how he said it. Let's see. In fact, USA Property and Casualty equity portfolio returned a positive 1% last year, a result dramatically different from most equity portfolios. So yeah, that was pretty cool. So you can hedge risk like this, 2008. My best years are in horrible years. So I do really well on markets crash. My theory in investing is, and it sounds horrible, it really sounds horrible, but I like it. I like to smile when everyone's laughing. I like to laugh when everyone's crying. That's my approach. I like to be mediocre in great markets, and I want to kill it in a horrible markets. So that's just the way I like to do it. It's a kind of a black swan type of investing. But anyway, that's good to see Joe Robles again. Great CEO. All right, let's talk a little bit about futures. A little bit different instrument. I do not like futures. I love swaps. I hate futures. I can't tell you why I hate futures and love swaps. When I took the CFA exam, they had one entire book. But the only purpose for the book was to prove that mathematically futures and swaps are the same thing. And I read that book. I understood it at the time. I couldn't repeat it all today. I don't think they asked a single question on the exam about it, but they are the same. My mind can think in swaps. I love swaps. I did a lot of swaps at UTSA. They're really wonderful things. I don't know if I can remember doing my last future. I just don't like futures. But a future, unlike an option, a future obligates you to do something. So you're committed, but do have in your notes, futures and swaps are essentially the same thing. For some reason, my mind can grasp what a swap looks like and how it works. But it obligates you to buy something in the future at some stated price. So you might say, I'm going to buy oil at 75 bucks in 3 months, and you're obligated to do it. If oil prices fall, you're going to be really upset, as you could have bought them at 60. I think they're back below 70 bucks again. You know, you say, I'll buy oil at 80 bucks, and now they're at 65. Well, you just lost some money. If you say, I'll sell oil at 80 bucks, you'd be really happy if oil prices fall. So with futures, when you buy, you're bullish. When you sell, you're bearish, but with one caveat. Be really, really careful with interest rate futures. When you're bullish on interest rate futures, you're expecting interest rates to fall, all right? So be careful on interest rate futures. It's the price of the bond, it's not rates, all right? So if you're bullish on bonds, you're expecting rates to fall, all right? So be really, really careful on that. When you're buying futures on bonds, you're buying it on assuming interest rates are going to fall. So just be really, really careful. Say, FinViz has a really good list of all the futures out there. In fact, FinViz is just a great site overall. They have something that you can pay for. I've never purchased what they have to pay for. Like this chart here, I don't know if I've shown y'all this chart. I think we saw this on the first paper, didn't we? Really, really good chart, kind of a mixed market today, right? But mixed chart. But if you click on the futures, they'll show you you've got the energy, crude oil, whether it's West Texas or Brent. You got gasoline, heating oil, natural gas, back up above $3, ethanol. Then you have your, there are futures on stock markets, on interest rates. Again, on the interest rate futures, they go up in price when interest rates fall. So I've known some people who get it backwards and they think, oh, wow, I did a great trade, and they say, oh, I lost money. It's like, no, you went the wrong direction in your mind. Then you have the agriculture stuff: cocoa, cotton, orange juice, coffee, lumber, sugar. Then you have your metals: gold, silver, platinum, copper, palladium. You have your cattle, soybeans. Now with Trump president, isn't China saying they're going to go after soybeans if he puts a tariff? Isn't that what he's saying? Shouldn't soybeans be down? Looks like they're down. But how much are they down versus the election? Where's the election? Looks like they went up after the election. They've come down since. So it's not always as obviously predictable as you might think on some of these. I was talking to an oil futures trader, and I asked him, what do you think oil prices are going to do? And so I don't think about that. That's not, and it's like, what, you're oil futures trader? But that's not what he was all about: backwardization, contango. He was all about roll risk. He was into the math of the actual transaction. He didn't have an opinion on oil prices.
Continue that surplus thing or whatever.
Contango is a normal. So we'll talk about it here. We're gonna get into it. Yeah, it's. I'm not a futures guy, so I have to really stop and think on contango and backwardation. But contango is the norm based on time value money. So you should see that. But that's what all traders are looking at. They're looking at that roll risk and what's going to happen when it rolls versus the current price. You have other agriculture out there: wheat, rough rice, oats, canola. Then you have currencies, which is, probably the most active today. For some reason, cocoa's up, coffee's up. That's good. We did a lot of coffee. and Costa Rica. The biggest thing down is oats. Why is cocoa up and oats are down? Don't understand that. Some in the middle. Gasoline is down, heating oil. You got palladium down, lumber is down today, orange juice is down. So it's kind of a mixed bag. Small cap is down today, whereas large cap is kind of flat. So, you know, it's any given day you look at it, it's hard to give a consistent story behind what's going on. There's so many factors going on. One of the guys worked for me, he ran USA's gold fund, really, really good manager. He's another person, if you ask him, why do you think gold's worth? He wouldn't give you an answer. My boss was so upset. He used to say an ounce of gold should cost the same as a really nice men's suit. Well, gold is going for what today? 2,000? And when's the last time, when have you bought a suit for 2,600 bucks? So oil prices, I mean, gold prices have gone up a lot more than men's suit prices because we don't wear suits anymore, but we still use gold. But how do you value gold? The exact same way you value Bitcoins. There's no basis. It's a speculative asset. It has no cash flow. There's no discounted cash flow. We don't know what gold is worth. And that was his position. We don't know what gold is worth. I loved his presentations because he just brutally told the facts. He didn't make up stuff he didn't know. He just told it and it was really good. He was pretty good. There was one point where he was the #1 mutual fund in the United States for 10 years. I don't mean #1 gold fund. I mean, he was the highest returning mutual fund in the United States out of all 4,000 mutual funds, mainly because gold was up. He was the #1 gold manager and gold was up when the market sold off in 2008, or doing a lot better. So a smart guy, you really know what he's doing, but he would not give you an opinion on gold. So, but he would tell you what drives gold. A weak dollar, inflation, a weak stock market, supply and demand, a strike in South Africa, Indian people in India are buying a lot of gold, the Chinese government's buying a lot of gold, you know, those kind of things. That's what he looks at. Tristan? War, yeah, any global crisis. I've never bought gold directly. I wouldn't know where to store it, but you can certainly buy gold ETFs. So anyway, and they got the VIX on here. Someone has asked me, can you buy the VIX? There are VIX. I mean, the VIX is awfully low right now. There are VIX ETFs, but boy, did they mess up. You should look at them when the VIX shoots up. They don't keep up. So if you buy a VIX fund and you see the VIX shoot up to 80, there's a good chance your VIX fund did not shoot up to 80. It may have only shot up to 40 or something. So they have a tough time. It's hard for them to create the VIX because it's kind of, you have to replicate it. So anyway, that's a good way to look at this. Is a good website. You can get really good charts on each one of these things. So it's a good place to go. So there's the spot price and there's the futures price. And this where it gets really confusing on sites like Yahoo Finance. Are they showing the spot price or are they showing the 3-month future price? So you gotta ask which one they're showing. So let's say the spot price is $100 and the futures price is 102. Now that's contango. So the futures price should be higher than the spot price. Why is that? Well, if you bought a barrel of oil today, what would you have to do with it? Let's say you bought 100 barrels of oil today and it shows up on your front yard. What do you have to do? You think your neighbors are going to let you just leave it sitting out there? You're going to have to go to a warehouse, aren't you? You have to store it somewhere. That's going to cost you something. Plus, you're out there $100 times how many barrels you bought. So you're out the time value money. So you can buy it today for $100. You have to store it, and you're out the time value money. Or you can not buy it today, but you can promise to buy it in 3 months. But you should have to pay more if you're going to pay out in 3 months because you get to save all the storage and you get to save the time value money. And that's called, have I heard this phrase cost of carry? Whoops, I wanted to highlight it. I didn't mean to do that. Cost of carry. If you buy it today, you've got the cost of carry. You've got the cost of having to hold on to the oil. You've got to store it. You got the time value money. That's the cost of carry. The futures avoids the cost of carry. And that's why future prices are normally higher than spot prices. So let's say costs you $1.50 to store it and it costs you 50 cents in interest to buy today versus delaying. Well, it costs you $1.50 in storage, 50 cents. It costs you $2. You're somewhat indifferent, right? If you buy today, you spend $2, already spent $102 in 3 months, you're out the same either way. So you're indifferent. And that's how markets should trade. That should be the norm. That should be perfectly logical. That it shouldn't make sense any other way. That's called contango. That's the norm. Now, the contango won't always equal the spot price of time value money, and people have different storage costs, but that should theoretically be the case. Let's say the futures price is 104. Then what are you going to do? A bunch of people are going to buy oil today and store it because they can buy today, store it. It costs them 102, and they can know that they can sell it for 104. They have an arbitrage profit. They pay 102 today. They know they're going to get it 104 in 3 months. That's an arbitrage profit. They make a bundle. So that makes sense. Now, backwardation, that's when the futures price is below the spot price. Does that happen? Yeah, it does happen. We talked about it in my risk management class. We have a case we talked about there. How often does it happen? I was actually going to go back and look that up, but I can't. It's a higher percentage than you would think. It's not 2%, it's not 80%, but it's a higher percentage than you would think. Now, you might say with backwardation, why don't I do an arbitrage trade? Well, what would an arbitrage trade? Well, you would sell the oil today, you would short the oil today and buy the futures. So you sell oil today for 100, 102, and you promise to buy it back for 98 in the future, and you got this big profit. Whom would you call to short oil today? You know how to do that with your stocks, right? You want to short Apple stock and you don't own Apple, you want to short it, you just call up your broker and they'll short it, right? They'll sell your neighbor's Apple stock. How do you do that with oil? Say, I'm selling 100 barrels of oil. I don't have any oil, but I'm selling 100 barrels of oil. Can you do that? You have a really, really tough time doing that. Now, if you already have 100 barrels of oil, what could you do? Then you could sell it today for 102, enter the futures contract for 98. Then you would have that $4 after your cost of carry locked in. But that's the problem with backwardization. There's no easy way for markets to actually arbitrage that trade because you can't really short physical assets. You can try it. You can try real estate. Try selling the Sears building in Chicago. You think it's overpriced? Try shorting it and see how you do on that. They give you $2 billion and say, I think it's only worth 1.6 billion. It's not going to work. You can short securities, stocks and bonds, and options and futures. You can short them, but you can't short physical assets. There's just not a market for it. So backwardization can exist mainly because there's no way to set up the arbitrage trade. And that's one of the reasons why this whole market blew up. And back in, I don't know if FinViz will show this. We should try it, right? It should be pretty cool to see. So let's look at West Texas. Let's go back monthly. I hate these little advertisements. There's 2020. Didn't quite show it as negative here, but that's monthly. I don't have daily. I don't know if I can do daily back that far. It won't let me do daily back that far. But back in 2020, we saw a few days there where the futures price actually went negative. Why? Because there was no more storage space. There was no place to put oil. So if you bought it, you could buy oil 3 months out and they would pay you money to buy oil. But where are you going to store it? So, yeah, I mean, it was a crazy, crazy day in markets. I don't think we've ever seen anything like that. Look how volatile it is, though. See what the 2008 crisis did, see what the 2020 crisis did, and we came out with the supply disruption. You know, oil prices are pretty volatile. You can look at Brent and see if that did anything more interesting. They can be very, very different because they are different markets. The U.S. market versus, you know, Europe. They can be different. Natural gas can be very different. We've seen natural gas where it's really cheap in the United States, but real expensive in Europe. Is there some trades you could do to take advantage of that? My guess is if there were, someone's already figured it out. I don't know those markets well enough to know. But if natural gas is $3 in US and $6 in Europe, How do you handle that? Well, probably the best thing to do is be Valero and create liquefied natural gas and sell it overseas. That'd probably be the best. But they're wild markets. Your entire career could be one of these assets. Your entire career could be soy. You could do soy, you could do cattle. That could be your entire next 50 years of your life. You do nothing but that one thing. You learn it backwards and forwards. You just trade that. You get paid really, really well to do it as well. So anyway, that's backwardation, contango. So for me, the futures market and really the swap market too. I don't know why. Okay, why are you moving? I didn't hit any button. Freeze. Someone Bill Gates just freeze. There you go. So in my mind, futures market is just another way to buy something. It's a very efficient way because you don't have to spend the money today. Remember, when you buy a futures contract or a swap, the entry cost is zero. It costs you nothing. The market value when you enter the contract is zero. There is no market value. It's going to change pretty quickly after that, but it's zero. There's no cash flow. So you do have to set aside margin at USA. That was no big deal. I just went to Donna and said, Donna, I need a bond. And she said, I got plenty of bonds. I'm going to hold maturity. She said, I need like $1 billion. Here you go. There's $1 billion. So it was a piece of cake. Really, really easy to do. Individual investors, you got to be careful because if you're trading these in a portfolio in a brokerage account, you don't have to move $40,000 over in cash into the account. So you're going to make sure you have the collateral sitting there ready to go. Because you get a margin call, you got to give them the cash right when they call it. A notional amount is just how many barrels you're going to have. That's your exposure. And that's going to tell you what your gain and loss is. You start off at zero, but how much your gain and loss is going to be how many barrels you're betting on. So when you come in at zero, and then if you have 1,000 barrels, if 1,000 barrels moves up $100, then you're going to make $100 or you're going to lose $100. Huh?
So if you do a futures contract for like oil, tell you what you getting oil essentially.
Well, you're going to get out of the contract before expiration. My guess, and I've never done that close, my guess is your broker is probably going to make sure you get out of the contract before. They probably watch really carefully at the end because there's no place for them to deliver it to you. And your custodial bank certainly doesn't want it. So you're gonna exit out of that before it matures. I have had options executed on me. I've never executed options. You almost always buy or sell right before the end, unless it expires worthless. You just let it expire. I have had options. I was talking to someone. I used to sell call options. I think it was yeah. We used to do covered calls, and some of those covered calls would get executed, and it irritated life out of me. But it was always executed on X dividend date. So I knew there had to be some tax strategy going on. Those are really irritating. But I myself don't execute because I don't really want that execution. So on futures, yeah, make sure you know the expiration date. Make sure you get out of that contract before expiration. Nothing can happen to you before expiration. Unlike a call option or a put option, they can't execute those on you if you're selling them. So if you buy them, nothing can happen. If you buy an option, you've got all the control. But if you short an option, they can execute on you, and you can suddenly have a really unusual looking brokerage account. So you should get the exact same return if your cost of carry, if the contango is right, if the contango equals your cost of carry, you should end up with the exact same return, whether you use the cash market or use the futures market. It should come out exactly the same. The nice thing about the futures market is it's very liquid. It's much easier to trade. You can do it in your brokerage account. It's a lot easier than actual doing physical barrels of oil where you need to have, trucks have to show up at your residence and they got to know that you're there, or you got to have a pipeline coming into your backyard or something. So futures are much more logical for someone who's trying to bet on the oil market. Now, if you buy oil ETFs, I would read their perspectives really carefully. A lot of oil so if we look at this market, this is the futures market. This is an extremely safe, liquid market. But then you have the swap market. I prefer swaps. A lot of ETFs, exchange traded funds, they prefer swaps. They're so much more flexible. You can do whatever you want to with the swap. but they're not as safe, they're not as liquid. Swaps can blow up on you. Futures can't. I don't think the SEC is going to let a future exchange go under. They're going to probably prop it up. So it's very, very safe. I don't know if we have any scenario there. So futures are very, very safe. I wouldn't worry that much about a futures contract not paying, but a swap, you usually have an investment bank or some banker like JP Morgan or Lehman Brothers underlying that swap. If they go under, you may not get your money back. And there are some exchange traded funds with some really, really hefty swap exposure. There was a Economist article on this, that there's investors who think these are safe investments, thinking you're in the futures market. If you're in a swap market, so I would look at your perspective. Are they using futures or are they using swaps? If they use swaps, I'd be a little bit worried about that contract. Lehman is, they blew up, and boy, there's a lot of people who were quite shocked at that. Yeah.
Well, how are swaps and futures the same?
Well, they're the same as far as the math, there's no insolvency. So with the swap, you're exposed to whoever the swap dealer is, whether that's JP Morgan, Morgan Stanley, Goldman Sachs, you're exposed to them. There's collateral, so you're in pretty good shape. There may be 105 collaterals, so for every $100 you have an extra 5. But if markets move really fast, I did a swap where our counterparty was Morgan Stanley. And I wasn't in that department anymore, but I'll talk about this in my risk management class. I told them get out of that swap, because if Morgan Stanley went under, they would have been in a lot of trouble. Because if Morgan Stanley went under, interest rates would have fallen dramatically. That swap would have been up like $1 billion. And they would have been telling their bosses, hey, we made $1 billion on a swap, but it's with Morgan Stanley's, so we're only getting 100 million. I was telling them, get out of the swap, move it to JP Morgan. My argument was, move it to JP Morgan, they're not going under. If Morgan Stanley defaults, you're going to have a big gain. You'll get it from JP Morgan, or just get out of the swap. So if they just get out of the swap, if Morgan Stanley doesn't go under, interest rates will rise. You'll be glad you didn't have the swap, because the swap would have lost. Then you can come back into it on Monday. So I'll tell them either way, either get out of the swap or move it to JP Morgan. Either way, you're going to be happy. If you're happy you're still in the swap, you're going to be glad you didn't have Morgan Stanley. If you're happy you're out of the swap, then you just buy the swap again on Monday. They didn't do anything. I think they made a mistake not to move. If that had been a futures, we wouldn't have worried about it. The futures market would have been fine. So yeah, you got to be really, really cautious. Don't assume just because it's exchange traded fund on oil that it's going to move exactly like you think it's going to, because it may not. All right. So futures is just another way of getting the cash market. It's probably the easiest way for you to do it on commodities as a retail investor. There are forwards and swaps are in the same category. These are not exchange traded securities. These are over the counter. You use these directly. They're a contract. In my risk management class, I show them a swap contract. They're complicated contracts, really complicated. There's paragraphs. The first swap I did, I read the entire contract. I highlighted stuff that I understand, and there were some sentences that just went on for 3 pages. It was crazy. So I asked my lawyer. He says, I don't do swaps either, but I got this firm. They're experts on swaps. I said, great, bring them in. He brought them in. I go, what does this paragraph mean? And that firm says, we don't know what that means. I said, great, you're the experts. You don't know what that means. So forwards and swaps, you've got some pretty complicated securities. One of the irritating thing with forwards and swaps are the contracts. You have multiple contracts. So for me, with my swap, it was between me and my counterparty, my portfolio manager, and my record keeper. I had to have 4 contracts or 3 contracts, and I had to get them all signed. If one lawyer changed something, I had to go back to all the other lawyers. It was so irritating. It took me months and months and months to get these things done. I talked in Investment Society a few weeks ago. Get this stuff set up in advance. If you think you want to do swaps, set them up now. Because if you think you want to do swaps and now you suddenly want to do them, you're not going to do them in 2 weeks. It's going to take you a long time. You got multiple parties you got to set them up with. That's a huge advantage with futures. Futures, you can just do them. As long as your policy allows you to do it, you can do them. So you have limited what we call counterparty risk. Forwards and swaps have counterparty risk. Essentially, that's credit risk. Sometimes you owe money on the swap. Sometimes it owes you money. If you owe money, you're not really worried about counterparty risk because you owe them money. You hope they go under and forget about you maybe. But if they owe you money, that's when the counterparty risk comes in, and that can switch pretty quickly at any given time. So that's counterparty risk. These are over-the-counter transactions, very illiquid, require sophisticated buyers and sellers. Once you get the contract set up, and there's two contracts, there's a contract in the annex, and then you have it with all the parties. Once you have it set up, they are pretty fast transactions. The first swap I did was like a 10-minute phone conversation. And that's because it was 9 minutes on my broker saying, I think I can get you a better deal. He was watching market and says, okay, go, but I really like this rate. But he waited a few minutes. He thought he can get me a better deal. My counterparty was Morgan Stanley and JP Morgan. Morgan Stanley was the scariest one. My view on JP Morgan, if they go under, the world's come to an end. The sun must have blown up, become a white dwarf or something. I mean, we're all dead. We're all broke. So I was not that worried about JP Morgan, but I was worried about Morgan Stanley. I mean, that weekend, oh my word, that weekend, Lehman goes under. Merrill Lynch is about to go under. No one wants Merrill Lynch. No one's going to bail them out. Finally, for some reason, Bank of America buys Merrill Lynch out for $30. Who knows why? But if they had not done, I don't know if people realize, y'all think of 2008 as a horrible year. It could have been so much worse. And it's really scary. I'm going to have nightmares tonight talking about this today. But yeah, Merrill Lynch had gone under. Goldman Sachs would have gone under. The domino effect, the Fed could not have done anything. It would have just been absolutely disastrous. So you thought 2008 was bad. It could have been a million times worse. So I'm glad Bank of America did what they did, although I think it was a bad trade, but it certainly could have been much worse. And a lot of these, Lehman, Goldman, and Morgan were huge counterparty brokerage banks for these transactions. So it was a scary time for swaps. Most future counter, back to Tristan's questions, most, if not 99%, are settled in cash, not in physical delivery. So yeah, you get out of the contract before it actually matures. And that's true with options as well. Most option contracts are settled before expiration. Okay, so that's it. So for the exam is whenever I'll email it out this week. I'll set up a Zoom. It's not a class. It's not a review session. I'm just going to have office hours where I'm going to talk to myself. I'm going to walk through a prior exam. You've kind of already seen it because this exam we've been working. Maybe I'll do a different exam. I don't know. There are other old exams out there that you can look at. You have the one I've been sending you, so you know exactly what's on the exam. There's zero reason not for everyone in this class to make 100 on the final. Now, what's the chances everybody in this class makes 100? It's pretty close to zero. Some students say, but there's so much to memorize. There's not don't leave yet. I'm not done. I get my last little soapbox. We still got 5 minutes. Some students say there's so much to memorize. There's absolutely nothing to memorize on this exam. There's nothing on this exam you should not know as a finance major for the rest of your life. Which means if you don't know it, you're in trouble. So you need to learn it. Don't memorize it. Know it forever and ever and ever. There's nothing on the exam you should not know as a finance major. All right. Questions on the exam, you'll have the full time, even though it's a 75-minute exam, you'll have the full 2 hours or whatever. It'll be in this room. All right. So one last quote to give you. I constantly say this is Charlie Munger. He passed away just here recently. I keep showing these quotes from people who just passed away in the last couple of years. I constantly see people rise in life who are not the smartest, sometimes not the most diligent, but they are learning machines. They go to bed every night a little wiser than when they got up. And boy, does that help, particularly when you have a long run ahead of you. He talks about, y'all have heard about compounding interest, the power of compounding. He talks about compounding knowledge. So that's what really bothers me for students that, they're on their phone in class, they're daydreaming, they don't come to class, or they memorize the stuff just for the exam. That's such a waste. To waste 4 years of college where you're not, if I were where you are, I would be desperate to learn every single smidgen of the thing a college professor gave me. Even in my history class, I'd be desperate. So I think that a life properly lived is just learn all the time. Now, he's not learning anything more now, but boy, he was learning a lot during his life. Smart guy. And he was still learning up until the day he's died. Man, he was into it. So smart guy. All right. So that's it. I wish you all well. Hopefully I'll see some of y'all in classes ahead. So. I've forgotten class to show you an example of papers 3 and 4. So here's one, a good paper from last semester. They have a title, their name, looks professional. They have an abstract that talks about the company that they're going to do the valuation on and what they're going to do in the paper. They do their discount rate first, starting with the risk-free rate. Just like I did in the video, you talk about your risk-free rate, talk about the market risk premium, where you're going to talk about productivity. Well, you talk about how the expected return on stocks is the current yield plus the expected growth, and earnings, which you're going to tie to U.S. economy, just like in the video. So you'll talk about those components, come up with your productivity and labor growth and inflation, come up with your final market risk premium. And in beta, you're going to talk about revenue sensitivity, operating leverage, bring in the chart on the volatility of net margins, talk about financial leverage, bring in the chart. And then you do the historical beta, the rolling beta, come up with your final answer. It's really helpful to have a table that shows why you came up with your final beta. And then your final discount rate. That finishes paper 3, but you don't make it a new document for paper 4. You go right into the valuation, give your main assumptions, the dividend, our free cash flow. You don't need earnings per share in this one. Long-term growth, you're going to probably tie it back to what you did in paper 3. Short-term growth, I gave you the 3 approaches there. You can ignore all of them. You should put them all in your paper if you can, unless you have some unusual data on the historical, and then come up with your final number for short-term growth. Then give me the dividend discount model. Make sure you put all the numbers in there so I can make sure to see if there's a math error, what happened. On the H model, you need to come up with your H, so make sure you have a short discussion on the timing of your H. Give me the entire formula so I can see, and at the very end, talk about your valuations versus the current market price, and then have a final recommendation to buy or sell. So the paper essentially takes what you did in Excel and just explains it in words in a very logical, organized way, bringing in charts to support your assumptions.